Hello friends, my name is Pinaki and welcome to my channel Fintech Logics. Today's topic of discussion is loan servicing. Specifically, we'll look at unsecured loan servicing. For your information, we have already discussed about loan origination, post-loan origination. Our loan enters into loan servicing. If you have not seen that video, I will provide the link here. The key takeaways from this would be loan service life cycle and key stakeholders. Just for information that this video would be specifically for unsecured loans. The incremental portion for secured loans as in collateral management, I would cover that in another video. So let's begin. So we have our loan servicing. I have tried to put a simplistic figure like this. So normally if you see our loan servicing moves like this, if there are no other changes or anything, then this is a very simplistic flow, which will start with create loan account. That means when disbursement is done, when there is if there is a need of any origination fee, we generate the origination fees probably at the same time, because origination fee, it can be adjusted with the disbursement amount, and also it can be collected along with the first installment. So as per the behavior, we generate the origination fee. Accrual of interest or interest accrue is something that starts normally, which is done on a daily basis based on the loan balance. So this is nothing but in simple, the process of identifying or calculating interest on a daily basis on the loan outstanding amount. That means on the loan principal amount, what is taken, or the disbursement amount. So this goes on for, let's say, for a monthly due loan, it goes on for 30 days. At the end of the 30 days, this amount is summed up and we generate the due for the entire portion. So what will the due contain? The due will have the interest accrued for the all 30 days, the principal portion that is payable, and if there is any fees that is payable. So all that would be part of the due. The due would be generated, accounting entries would be passed. So this due means that your customer has to make this payment to the lender. Now, as per the setup, we collect payment. So it can be from your wallet, or it can be by a mandate from your bank account. So the collection of payments happen. There is one important step here which comes as the next one, which is apply payment. So apply payments means, first thing, recognizing the payments under different heads. So if you have a combined due of $100, and out of that $100, $50 is principal, $20 is interest, and $30 is fees. So that recognition of the amounts, or bifurcation of the amounts into different buckets so that it can be applied, is called as applying payments. So it can also have some complexities regarding if there are multiple dues pending. So which due would be applied first, all those complexities can come. That is the process of applying payment. Now once your payment is understood or recognized, we update the loan balances, and we also update the general ledger, what is payable for what is receivable for the loans. There is one periodic process that is done for reporting loan details. So in India, we have to report that to uh, a credit bureau. We also have to report on a periodic basis to the central bank, which is RBI. In US also similar arrangement is there, where the credit bureaus are notified and also a central bank. So reporting loan details is very essential and is mandated by compliance. Uh, Simultaneously, we also update the risk and limit of that particular loan account, and also for the loan portfolio. So if a certain principal amount is paid in form of the first due, that also increases the customer's limit. So I'm just giving an example. So in that way, we update the risk and limit. Now, This process goes on continuously, this payment process goes on continuously. And once all the installments are paid, that means all interest, all principal, all fees are paid, um, we can mark the account as paid off, right? Account payoff also means that account would be closed, all your liens, everything would be removed, and your account can be marked as closed. You terminate the contract and issue a no objection certificate that nothing is due from the borrower. So, in simple terms, if there is no other factors, the loan life cycle would be simple, very simple like this. So, where we would see the key stakeholders. So, borrower, as you understand, borrower, lender, and co-lender are the primary stakeholders here. As you are doing a reporting on a monthly basis, we have our credit bureaus and other credit rating aggregators to whom we are providing monthly data. Now, FLDG insurer, as we talked about, if the first installment is not paid, FLDG or insurers bear the risk and make that payment. So they are involved. Payment facilitators are involved to collect the payments from different channels and settling that. And take ecosystem, which takes care of the loan flow and also the general ledger, right? So these are the stakeholders which are involved. Now, apart from this, we might need these additional processes based on a case to case basis. So, account servicing. So, for example, yeah, the borrower would need a loan statement, right? So, that would be part of account servicing that would be given. DPD and delinquency. So, DPD is days past due, the number of days that the customer has become overdue and not paid, it called as days past due. So, as part of DPD, if there is a delay in payment, marking the DPD right from your 1, 2, 3. After your grace days, normally we start marking DPD, and on certain date, marking that as delinquency. When delinquency might have multiple buckets, delinquency one can be 0 to 30 days, 30 to 60 days, like that. So all those are part of your DPD delinquency. These are automated processes that we do in system. Penalty computation is the process where there is delay in payment and there would be penalty charges which should be calculated on this penalty computation. Prepayment is when borrower says that I want to make a partial payment, right? Additional payment which is over and above is due, that he has to pay, and we have to do apportioning or do apply that payment against interest and all things which are there at that point of time, and the remaining amount to principal, right? So that is the part of prepayment. Now, prepayment or foreclosures are very closely related. So prepayment is normally referred to as part prepayment, where not the entire loan principal is paid, only the part is paid. And foreclosure is normally the entire loan amount outstanding is paid and the loan goes to a closure status, or the loan is paid off. Moratorium, in simple, which was very prevalent in terms of COVID, where it's a kind of deferring the loan account, that okay, the borrower would not make any payment for, let's say, 1 month, 2 month, and after that, whatever interest would be computed, we will do certain treatment with those amount, and that would be taken. So it's as good as giving some additional time to borrowers for 1, 2 months, but definitely the interest amount for that month is taken in certain form, and that is called as moratorium. Loan modification is simple, where somebody wants to do the borrower normally asks for, let's say, I want to change the payment date, instead of first, can you make it as third, right? That kind of payment. Or instead of, let's say, the remaining installments are 12 installments, can you make it can you shift it by 1 day or something? Now, loan modification and restructuring are used pretty interchangeably, but there is certain difference. So normally, you understand as, if there is a change to payment schedule, it goes for restructuring, right? So restructuring can happen based on customer requests. So instead of, let's say, 12 outstanding installment, customer wants to take it pay it off in 10 installments, or want to increase the stance by another 12 months to make it 24 months. So all these kind of changes which will make changes to payment schedule. And sometimes restructuring also happens by when the customer makes an additional payment where principal is adjusted, right? So at that point of time also restructuring can be triggered. So this is, in short, loan modification is you change the payment dates, etc., the address, bank accounts, etc., and restructuring is anything to change with your payment schedule. Delinquency management is a big part. So I have kept it under repeated delinquency marking and delinquency management, because this can be a long process if the customer does not pay for a long time and it goes to, let's say, non-performing assets below 90 days of DPD. So delinquency management is triggered where there is a lot of processes which are done, like marking a certain loan under a risk bucket, even stopping the accruals, even starting your delinquency process, starting your legal processes, etc. Right? So delinquency management can be a long process. Uh, Third party collections, it can be a process where um, the the amount which is not paid and become delinquent, um, the lender ties up with a third party collection agency. There are a lot of collection agencies these days who not only utilize their network or manpower to collect, not in terms of dubious methods, but in terms of high-end methods like proper contracting way and reaching the customers, right? So taking the help of AI and ML to also look at the behavioral pattern of the customer, the borrower, to make him pay, right? Third party collection agencies are there. In case the claim management is involved where there is non-payment, right? FLDG case, we heard that, okay, if there is not, the installment is not paid, then uh, the FLDG pays back that amount to the lender, right? So in that case, claim management is triggered. Write up is something that the lender tries to collect all possible ways, but still a certain portion of your loan is not recovered. So at that point of time, the lender marks the loans as write off and kind of declares a loss on that loan. Now, reversal and validating, though I have put it as a one simple box, this is probably the most complex process where any transactions that you would have done can be reversed in system, or it can be validated. So it might be um, uh, a validated payment. So a customer has made a payment, but uh, the payment has not reached the bank, but it is not a fault of customer, right? Borrower. At that point of time, after 2 or 3 days, we can actually give benefit to borrower by applying the payment on a old date, so that the penalty and other things would not be applied on the borrower. So that is the process of validating. Now, loan top up, sometimes the borrowers will come and ask for additional loan disbursement. At that point of time, either in some cases it can be treated as a separate loan, or in some cases this loan amount can be added as an added to the outstanding, and your installment can be modified, right? So loan top up is that. Loan transfer, where um, the loan is transferred between two lenders. So normally the borrowers should know about the transfer of the lender. So communications are made, when arrangements are made to move the loan from one book to other. So those come under loan transfers. Even this is a specific, the last one is the refinance management, where the borrower himself has come from some other bank to this bank and ask for a refinance. So in that case, how the settlement would be made to the previous lender and a new loan book can be created here in the new lender system. That is all about managing the refinance. So this is, in short, the loan servicing life cycle, right from your create loan account to closing of loan account and issuing an no objection certificate. I hope this video has made a picture clear about loan servicing. Please let me know in the comment section if you need any particular section in detail, because for one slide, putting all these details and covering that in 5 to 6 minutes is very difficult. If you need anything in detail, I would definitely make one more additional video on that. Thanks a lot, friends.